Hey, everybody, and welcome back to the podcast, episode 148. Today, we're looking at something that some consider to be too good to be true. That's right, we're looking at section 1202 from the IRS, QSBS. It's got a nice little ring to it. You're going to learn more about it here in a moment with a great guest. But as always, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Hey, everybody, and welcome back to the Teaching Tax Flow podcast. Obviously, you know why we're here, because hopefully you can read the title and the show notes if you dug in a little bit deeper. But on this topic, we got another good one that you may not expect from us with some of the content that we've been doing recently, but we promise it all ties together. And Chris Picciurro, welcome back to your own show, sir. You know, we do open the door for you every once in a while, you know, to let you come back. So welcome.
Well, I appreciate it. I'm really excited about our special guest this week. A couple of things. Remember, within Teaching Tax Flow, we have 3 laws. One of those 3 laws is that cash flow and tax flow are different, meaning not all income is taxed the same. And one of the things we want to focus on is not just tax deferral, not just tax, putting money away into retirement, which could be important, but strategies for people, especially business owners that we're going to talk about today, to enjoy tax-free income, tax-free capital gains. There aren't that many spots in the tax code that allow for this. One of the other laws is that tax agencies are our involuntary business partner, and tax laws are written to encourage and discourage certain social, economic, environmental behavior. And one of the tax laws that we're going to dive into today can really, really help those small business owners, small to medium-sized business owners, actually a lot of different business owners. And we get a lot of questions in the Teaching Tax Flow community, not just on the private Facebook group, but in our private CPA practice. They really, usually the question is that the entrepreneur doesn't know what the heck they're asking about, right? But what they're asking is, hey, I heard there's a way to not pay tax on millions of dollars of gain when I sell my company. And they might hear about QSBS, or they might hear about section 1202, or but they don't really know what they're talking about. They just heard that they might be able to take advantage of this. And that's why we bring in the best guests. So excited. So excited.
You're so excited you can't even get the words out, man.
I'm tongue-tied, right? John, and Brady, Brady Weller's with us from QSBS Rollover. I'm so excited to have him. And John, you know that I've been waiting for this topic for a long time. We've been really looking for that right person. And Brady is the man. So welcome to the Teaching Tax Flow show, Brady.
Thanks, John. Thanks, Chris. Appreciate it. Yeah, I love your content. Glad to be on.
Yeah. So Brady, basically, Chris is so excited about this, right? Like this is kind of his, I guess we can call it like the white whale content, very similar to the one that I put on the list a couple months back that he absolutely did not want to do. And I used some very bold, I think I bolded him, italicized him, and put him in red, no complaining when I threw some topics in there. So this is his version of mine on the Venmo tax. So let's, don't let him down, sir. Don't let him down, because I have to deal with him crying afterwards. So,
yeah, I mean, Chris, you mentioned tax mitigation, especially capital gains tax mitigation, that most people maybe know about. And from listening to your content, some others' content, like opportunity zones, 1031 exchanges, QSBS fits right in there, but it's even more powerful. So excited to jump in.
Yeah, well, can you give us a little bit of history? A little birdie told me that you're a Baltimore Oriole fan, and we are recording this on your birthday. So we're gonna So for for those of you watching on YouTube, you could see, is that Camden Yard?
Yep, this is opening day, 1992 at Camden Yards. Well, it's a painting, but I guess someone was up in the box sketching it out. So
yeah, it's a gorgeous stadium. John and I actually were there a few years ago for a conference. We got to go in one of the boxes. It's just it's just not even, it's more than a stadium. It's just an awesome area, but
It's basically a landmark.
It
if I
is,
had to
yeah.
come up with
Yeah.
anything else.
yeah, it's really nice. Tell us about a little bit about yourself, how you got into this QSBS space and what excites you about it.
Yeah, of course. Again, thanks for having me. We were running a different business actually in the alternative asset space. So several years ago, was an early employee at a firm that was doing wine and spirits investing, and we still are working on parts of that entity. But today we do QSBS exclusively, and that was a really big pivot for us. But we came across qualified small business stock while we were exploring the alternative asset space back then. We had a family office who was making a lot of early stage investments, and we were talking with them about QSBS. Ultimately, we started diving deeper. We found QSBS Rollovers, which I'll dig into today. And we realized that it was, again, the most powerful tax exemption in the United States, but there was basically no infrastructure around advisors helping people to maximize it. When you think of 1031 exchanges in real estate, or you think of opportunity zones or qualified opportunity zone funds, there's massive infrastructure, both among financial advisors, attorneys, and whatnot, to support that industry. And there is absolutely none of that in the QSBS space. You'll find about 75 attorneys across the country who have any kind of advanced knowledge about QSBS, and probably another 75 CPAs. And so I've spent the last 2.5 years doing functionally nothing else except digging into QSBS. And we've developed a set of services to allow business owners exiting to capitalize on it if they qualify. So
Awesome. And can you give us a 30,000-foot view of what QSBS is and what type of business owner should be thinking about this?
sure. Yeah, there are some, it's not one size fits all, but there are sort of some indications that a business or a type of stock might qualify. And so we're only looking at C Corps. So this is stock issued from C Corps that has been held for at least 5 years traditionally. So qualified small business stock is income tax exemption that can be claimed up to $10 million, mostly for founders, or 10x the basis in the stock. I always use $10 million because founders have no basis in their stock. They got it on day one. So for the purpose of this $10 million exclusion, if you hold C Corp stock for 5 years and you are not operating in a excluded business category, those are businesses like financial services, medical services like doctor's offices, real estate, other investment companies. So tech, manufacturing, e-commerce, any of those types of businesses qualify, and more than 90%, 95% or more of venture-backed startups are going to qualify for this exemption.
Wow. And is that exemption per entity, per shareholder, and do you have to be the original shareholder to qualify?
You do have to be the original shareholder. That is, your stock has to be issued directly from the corporation.
Okay.
So founders obviously got their stock on day one. Early employees who exercise their options and take hold of stock would start their QSBS clock ticking.
Nice.
Now, outside investors who purchase a minority interest 7 years into the business through a secondary channel, they're not getting that stock original issuance, so they would not qualify. But the benefit applies per entity, so per issuer of stock, as well as per shareholder, which means that if John makes 5 different angel investments in 5 different companies, he might have 5 different $10 million QSBS exclusions per investment that he's made.
Wow. So if an individual could have multiple QSBS exemptions but the
If
$10,000
John knocks it out,
limits per entity. Yeah.
if he knocks it out of the park on all 5 of those angel investments and makes $8 million on his $50,000 check in each of them, that $8 million is federal income tax exempt. And John, I don't know if you pay taxes in Tennessee or where, but probably state tax exempt as well, as long as you're not in California or Pennsylvania. But, yeah.
And if that ever happens, I'm going to completely hide
states.
my crystal ball in the closet, so nobody else can.
And
find
John's
it.
not going to be on the tax flow podcast if he hits $40 million exit.
Nope, we're going to a cardboard cutout of me
There you
at
go.
that point. So
We would ask him to be a sponsor at that point.
Nice.
We'd name the studio after him.
there you go.
Yeah.
That's up for grabs right now.
So QSBS that's section 1202. I know you mentioned the numbers early on, and some people, when you're Googling around, you might see section 1202, which is the code text, or you might see qualified small business stock, QSBS. Now, there is another part of the code, and that's what our firm works explicitly on, and that's the number of the code is 1045, and it's called QSBS Rollovers is what we call it. Some people call it a 1045 rollover. And what that means is you can actually take the gains from the sale of qualified small business stock, the type of stock that I described, and you can reinvest those gains into new qualified small business stock. So if your listeners are familiar with the 1031 exchange, where you take gains from a sale of property and roll it into like-kind property, this is the 1031 exchange for company stock. Now, the reason why someone would want to do this is because when you do a QSBS rollover, it allows you to continue your holding period, meaning if you sell stock in your company at year 3 and you say, man, I didn't reach the 5-year period for the QSBS exemption, now I owe taxes. You actually have 60 days to reinvest that money into new stock, and it will continue your holding period. Maybe you hold that new stock for 4 years, so you're at a combined 7, and then you exit. Now you can take your exclusion because those holding periods tack on. So it's extremely powerful, but it's not powerful if there are no good rollover options. So traditionally, it's like, hey, I exited my startup at year 3. I have this big tax bill, but I'm not going to just go invest in John's startup. Like, he's going to burn my money statistically, or they're going to fail statistically. So that's not a good tax planning tool, right? So when we stepped back and we looked at the code here, we said, hey, why is there so much infrastructure and help for people to execute other kinds of tax exemptions, and there's none for QSBS and QSBS rollovers? And so we dreamed and we said, hey, what if there existed an always available, downside protected, and highly defensible option for people to execute these rollovers? We think internally that founders leave around $15 billion on the table every year because they don't maximize QSBS. We will see about $3 billion worth of exit volume next year from founders with this exact problem, is our estimate. And from September to May, we saw more than $1 billion just in the first, call it 6 months of us running our newest program.
Wow.
So it's a massive problem.
No, it is, because I'm in being a CPA firm owner for over 20 years, let's put it this way, most people that exit their business or get an offer, sometimes an offer that they can't refuse to exit their business, typically C Corps aren't used as much, or they didn't realize 5 years in advance that they were going to get it. So the practical problem this solves is I've got someone that's positioning and maybe elects for their LLC to be taxed as a C Corp. 2-3 years ago, you're solving the problem that they didn't see who the heck sees 5 years in advance when you're a business person, right? So you're kind of helping solve that problem for them where they could still qualify for the QSBS.
Yeah, now, frankly, we work on the coasts just because, like, venture in New York, venture in California, and that's just right down the fairway for folks who are going to qualify. But we're seeing so much more in Chicago, in Denver, in Austin, in Miami, in DC, Virginia. Startup ecosystems are blooming in those places. Our bread and butter are the coasts because that's how sort of the capital is played out. But if you have a pass-through entity, maybe you have an S Corp, a lot of these family businesses looking to exit in the next, call it 3 to 5 years, or looking to make a generational transition in the next 3 to 5 years.
Yes.
Then you do sort of have an idea of, hey, can we move things around, convert to a C Corp, reissue some new stock, reformat things here as we plan for an exit. Now, it doesn't work for every industry because you do need to do a stock sale in order to execute QSBS. So I know for many of our listeners who have service businesses, any exit just isn't going to be a stock sale. It's going to be an asset sale of some kind. But there are, ways that you can fashion deals to make it work. And it's certainly worth exploring given the benefits.
And a lot of the people that do more asset sales and stock sales might be in an industry that is not going to qualify for QSBS anyway. So
That's possible.
but
Yeah, it's possible.
if you're, that, so can you talk kind of through the mechanics? So obviously, someone that has a qualifying business, 5-year hold period, can exclude up to the $10 million of capital gain. Remember, it has to be and we have some content on this, a stock sale, not an asset sale. Now, a lot of times what we're seeing in many of the industries, the stock sales are becoming a little more prevalent because of like contracts. So you might have a contract with an entity that's not transferable to another one. So that could be the case, or the C corp might have R&D credits carrying forward, or NOLs. There could be some tax attributes in that C corp that the acquiring company would like. But can you tell us about some maybe a little more on the rollover mechanics, just from a 30,000-foot view again? Like, hey, I've got a tell us a client success story. Obviously,
Sure.
you're not going to say
Yeah.
the names, but
Yeah.
that's probably the best teller of someone that maybe has been working for 2 or 3 years and as a C corp or in
Well,
worked out.
we're seeing these all the time right now because of the AI boom. I've seen full exits in less than a year. I've seen, $100 million plus seed and Series A rounds, which, are extremely large. Opportunities for founders to be taking large amounts of liquidity via secondary at Series A. So mainly talking about venture-backed businesses here, and I can tell you, give you an idea of a success story from maybe a place like New York, where for larger exits, the combined federal and state tax rate can be 35, 37%. And so on $10 million, you're looking at a $3.5 million tax bill. So say a founder in New York exits for $5 million at year 3. They have an AI business and they sold it to a larger company. At $5 million, they're on the hook for, a 7-figure tax bill. Taking that money, literally the cash that got wired to them, they would come to, typically if they're working with us, they would come to us and say, hey, I want to do a QSBS rollover. We'd say, great, you have a couple different options. You can make an angel investment or, deploy capital to an outside business. We've described maybe not the best for most people's situations, but there are 2 other things you can do. One, you can start your own new company and issue yourself stock in a new business, just like you did when you founded your first company. And you can immediately start running that in a qualified sector. And that can be your rollover. Or you can start a new company and you can do market research and development work to go out and identify a business that you could acquire or start. And the IRS is actually going to give you a safe harbor period, call it like a rolling 2 to 3 year-ish period, where they're going to say, hey, all of that research and development, that startup work, that exploration for a business to acquire, we're going to call that working capital for these purposes. And so you get QSBS credit for that. So that's a really interesting option. Now, something you can't do is just create a new C Corp, throw money in there, sit in Cabo and say, yeah, I'm emailing some folks about buying their business.
Right.
We believe that the bar is extremely high for substantiating these, and the larger the numbers get, right? A couple $100,000, fine, but you get into several $1 million, a little bit harder to substantiate that, yeah, I'm actually going out and doing R&D work. And so that's what our firm does. We do end-to-end rollover compliance, substantiation, and market research in order to justify the use of proceeds in your new rollover entity.
So a couple.
And yeah,
Oh no, that makes sense. So just like we talked about, it's ideas are cheap, implementation's valuable.
Yep.
So having the right implementation partner, like your firm, is important. You can't. I do have a question. So when someone does, let's say they're doing the QSBS rollover, they sell their company stock, they get wired, for let's say $8 million. Does that have to go through an intermediary similar to a 1031 exchange, or can it hit their bank account and then they try to do a rollover?
Yeah, it's actually, they can just do it directly, and it's fungible as well, which means that you could get that money, you could throw that $8 million in a treasury account, then you could pull a line of credit off of it and use the money from the line of credit. Like, yeah, it's completely fungible. $8 million,
Wow.
$8 million. And that the rollover is a claim that you would make on your Schedule D when you file your taxes. And so someone has their exit, that $8 million, they have that $8 million gain recorded. They're going to work with their CPA to write, below it, basically, we're claiming 1045, we're claiming a QSBS rollover and a gain deferral. What that means is if you do that within 60 days, whether you roll over $8 million or $5 million, whatever portion, you can claim that as a deferral for the period that you're in that new business. And then down the line, maybe you hold that stock for another 4 years, and then you get liquid again, pull it out. At that point, you'll be able to claim your tax exemption under Section 1202 and QSBS. So a rollover in itself is a continuation of QSBS and tax deferral, and then QSBS is ultimately what gets you to the exemption.
Oh. Yeah, so if you're a tax professional and you have clients out there that you think Brady and his team could work with, just reach out to us. If you're a business owner, you're thinking about exiting. Are there? I have two more questions, and I know we'll wrap it up. Are there any type of related party rules, or let's say I'm selling my stock to one of my children.
Yeah.
Ain't that?
Yes, that can come up, and really it's going to come up when we're talking about related party sales and conversions. So we want to be careful with those transactions. We want to be careful with the purchase, the sale, the reissuance of stock, all of those sort of events that happen maybe on the balance sheet of the company, whether they're buybacks or redemptions, any of those types of transactions. If you have QSBS in mind, you're going to want to work with someone to pay attention to the implications there. We have maybe the broadest network in the country of those 75 folks in each camp, CPAs, attorneys, people who can help you navigate that. And we do free consultations in terms of checking out your situation and helping to point you in the right direction. So if you've heard me talking about venture and you say, well, that just doesn't apply, still worth reaching out and seeing what the options could be.
In my final question as we wrap it up, because a lot of people would like to know, has OB3 changed or allowed this to continue? Is this something that we have to do before the end of 2026? What's the future of QSBS look like? Kind of that from a broader view.
Yeah, Section 1202 QSBS started in '93. It was expanded to where it is. Was earlier this year by the Obama administration in 2010, 2011, and then it's been expanded again. And so back when it was expanded maximally the first time, it was a Democratic administration, Democratic Senate. Now we have it in a Republican White House and Republican Senate, expanded once again. It's seen bipartisan support for 25 years or more, and rollovers the same. Rollovers were implemented in 1997. So we're extremely confident in the long-term health of QSBS. It's clear that both sides of the aisle want to incentivize innovation and entrepreneurship and deployment of capital. So yeah, OBBBA made QSBS even more powerful. It expanded the exclusion cap from $10 million to $15 million per person, per issuer, and it expanded the gross asset test. So when you talk about small business, these businesses issuing eligible stock used to have to be under $50 million in gross assets. That's been expanded to $75 million, which means that for venture-backed businesses, probably up to Series B and maybe even beyond, depending on the size of fundraisers, they're going to keep issuing that eligible stock. And the last thing is there's been a tiered exemption implemented, which means that if you have stock issued after July 4th, when this went into effect, even if you hold for 3 years, you can take a 50% exclusion, 4 years, a 75% exclusion, and 5 years, that 100% tax exclusion up to $15 million goes into effect. That's all stock issued after July 4th. For most people we're talking to, that's just not in play yet. But over the next 1 to 3 years, we're going to start seeing a ton of folks in that camp.
That is awesome. Well, thank you so much. And John, I know you're going to put a lot of Brady's information in our notes. What's the best way to reach out to you and the team at QSBS Rollover?
We're easy to find, QSBSRollover.com. It's easy to schedule a call with us. Both my co-founder and I and our team are available to chat with anyone at any time. Happy to work through your situation. You can follow us on LinkedIn. We're pretty active there. Follow me on LinkedIn. I post funny stories about people missing out or being able to take advantage of QSBS. So look forward to seeing people. Not
John,
hearing
you're
you,
muted.
John. Yep.
You're muted.
Oh, there we go. Holy cow. Talk about missing out on things. Here I am. I muted myself and I'm talking about missing out. I was going to say probably the examples that you give of people missing out is absolutely hilarious at some point, but to other people, not to them. So we'll definitely drop your contact in there. I know we could take this down probably many avenues, many examples of diving into specific stuff. So I'd probably say, and Brady, tell me if I'm correct, is if anybody has these questions a little bit more in detail, we just skimmed the iceberg basically on this one.
Absolutely.
Any of those questions, reach out to you directly and you guys could dive into those on a case-by-case basis, correct?
100%. Yep.
Awesome. Well, thanks for joining us. I appreciate it. And Chris, hopefully, this guest we have here stood up to your expectations on the topic. So now
I had no doubt he would. So
we don't
I'm
have to
really
get
happy.
you, a little cheese plate and play the fiddle for you. You should be okay. So awesome. Chris, thanks for the introduction to him. Brady, thanks for joining us, man. We'll drop your contact in there. And again, if anybody has those questions, drop him a line, him and his business partner. Again, don't be lazy. Right there in the show notes and down here and off to the side, depending on what platform you're looking at. Check it out, and we will see everybody back here again next week. Different date, same day of the week, completely different topic here on the Teaching Tax Flow podcast. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.